U.S. Defense Secretary Pete Hegseth has declared that the U.S. military is locked and loaded, ready to strike Iran's power plants and energy industry if no deal is reached to end the war. This strong warning comes directly after President Trump announced a naval blockade targeting Iranian ports and merchant ships in retaliation for disruptions in the Strait of Hormuz. The United States Navy now effectively controls traffic going in and out of the strait using real assets and capabilities while deploying less than 10% of its total naval power. At the same time, Treasury Secretary Scott Bessent launched Operation Economic Fury to maximize sanctions and apply overwhelming economic pressure across Iran's entire government system. Pakistan's army chief recently met with senior Iranian officials in Tehran to help push for a fresh round of peace negotiations between Iran and the United States. The first round of talks held in Islamabad ended without any major breakthrough, but the White House says discussions have continued to progress steadily since then. New sanctions have ended a previous reprieve on Iranian oil shipments at sea as part of the tightening naval blockade around Iranian ports and waters. Experts analyzing the situation explain that the blockade is effectively choking off Iran's access to global trade, with 95% of its economy depending on Persian Gulf flows. Iran's economy is heavily reliant on fossil fuel exports, with 40% of the government budget coming directly from oil sales that must pass through the Strait of Hormuz. With very limited onshore storage capacity, Iran can only hold extracted oil for about 13 to 14 days before it faces the need to sharply reduce production rates. Such reductions would cause significant and permanent damage to Iran's oil extraction infrastructure, while triggering higher unemployment and severe revenue shortfalls for the regime. The expert further notes that without oil exports, Iran stands to lose over $350 million per day in trade, severely straining its ability to pay salaries. A critical issue involves the armed forces budget, which relies partly on oil allocations that the regime must sell to fund military and security operations. Targeting Iran's so-called dark fleet adds another layer of pressure, as these tankers carry stored Iranian oil in international waters waiting to be sold to buyers in China. The military will also pursue vessels, providing material support to Iran, including those carrying chemicals and parts needed for missile production and refinery repairs. This comprehensive strategy aims to increase direct pressure on the Iranian regime while encouraging other nations to become more actively involved in enforcing the blockade efforts. These developments occur alongside President Trump's announcement of a 10-day ceasefire between Israel and Lebanon, aimed at opening the door to wider negotiations with Iran. Although markets are treating the ceasefire as a potential catalyst for talks with Iran, Gulf and European leaders remain cautious about the timeline for any final deal. They privately warn that reaching a comprehensive peace agreement could still take roughly 6 months of difficult and complex negotiations before it can be finalized successfully. Meanwhile, the Strait of Hormuz remains completely closed, with no meaningful flow of oil or gas moving through this critical global energy choke point at the present time. The direct result, Brent crude oil prices surged above $99 per barrel today, rising roughly 4.5% in a single trading session. Futures curves are showing clear backwardation, which signals that traders expect near-term oil supply to remain extremely tight due to the ongoing disruptions. The situation raises serious stakes for the real economy, as Gulf leaders warn of a potential global food crisis if the strait stays closed much longer. Wall Street banks, including JP Morgan, Goldman Sachs, and Barclays, have begun tightening leverage terms on private credit funds while preparing for higher risks in financial markets. Yet even as these banks prepare for higher risks, the real question is how long Iran can possibly survive this brutal economic blockade before its regime begins to crack. The expert analysis shows Tehran is losing over $350 million every single day, with no oil exports flowing through the closed Strait of Hormuz. Limited storage means they cannot keep pumping indefinitely, and production cuts will soon cause permanent damage to their fields, along with rising unemployment and social unrest. At the same time, China is playing a dangerous double game by continuing to buy discounted Iranian oil through its dark fleet tankers and shadow networks. Now, Beijing clearly wants to keep the Iranian regime alive, both for cheap energy access and to use Tehran as a strategic thorn in America's side in the region. There are also indications that China could be supplying Iran with dual-use goods and materials that help sustain its military and missile programs under sanctions. This hidden support helps explain why oil prices have risen sharply to $99 but have not yet exploded higher despite the total Hormuz shutdown. The investment research report captures this tension perfectly, noting that Brent crude has hit $99, with futures curves firmly in backwardation. Energy prices currently sit between the ECB staff baseline and adverse scenarios, giving European central bankers just enough cover to delay their planned rate hikes. JP Morgan has now pushed back its call for ECB increases from April and July to June and September as a direct result of the Middle East uncertainty. In the United States, the report reveals a manufacturing sector recovering strongly but struggling with sharply higher input costs and refusing to add new workers. Philadelphia Fed survey shows surging new orders and business activity, even as its employment index has turned negative, signaling caution among factory managers today. Remarkably, initial jobless claims remain near the lowest levels of the year, proving the American labor market is holding remarkably firm despite the commodity price shock. This resilience allows the S&P 500 to reach new record highs while the Nasdaq posts its 12th straight green session amid the geopolitical drama. However, the report warns that underlying market momentum is fading fast as algorithmic buying has largely run its course, with dealer gamma at peak levels. The next potential support for stocks would need to come from risk parity funds, vol control strategies, and active managers using earnings season as an excuse to add exposure. Yet the through line in the research is clear. Markets are pricing an optimistic, quick resolution, even though the Strait of Hormuz remains firmly closed. Inflation pressures are building on both sides of the Atlantic as central banks find themselves caught between the need for patience and economic necessity. As inflation pressures calm economic necessity, Gulf leaders are already warning that a global food crisis could emerge if this critical waterway stays closed for much longer than the next few weeks. Former Treasury Secretary Paulson has called for an emergency plan for the $31 trillion Treasury market, highlighting the unique dangers of this situation. Private credit funds are seeing collateral markdowns and significantly tighter borrowing costs, as Wall Street braces for prolonged energy market disruptions ahead. The full picture is far more complex and dangerous beneath the surface of these record stock prices and optimistic ceasefire headlines we are seeing. This leaves us wondering who will blink first in this high-stakes standoff, the economically battered Iranian regime or the markets betting on a fast diplomatic breakthrough. The coming weeks will tell us whether Trump's aggressive pressure campaign succeeds in forcing concessions or whether external support allows Iran to endure longer than expected. Yet the truth is that external support from Beijing may already be buying Tehran precious time, while American taxpayers foot the bill for this naval showdown. China's dark fleet tankers keep sucking up discounted Iranian oil, feeding Beijing's factories, and quietly shipping dual-use parts to keep Tehran's missiles flying. The cynical game explains why $99 oil feels shocking but not yet catastrophic, because shadow trade flows blunt the full impact of Trump's blockade. Meanwhile, the investment research report lays bare the tension central banks are now trapped between patience and necessity as energy prices straddle their worst-case models. The ECB has blinked, pushing rate hikes to June and September because ceasefire headlines gave them cover even though Eurozone inflation is stuck near 3%. In America, factories are roaring back with Philadelphia Fed orders hitting cycle highs, yet employers refuse to hire and input costs are exploding higher. Jobless claims stay rock bottom at 207,000, proving the labor market is the most insulated in the world from this Middle East commodity shock. Stocks keep making new records. The S&P eked out another close, while the Nasdaq posted its 12th straight gain, but momentum is clearly fading fast. Algorithmic buying has exhausted itself, dealer gamma sits at peaks, and the next bid must come from risk parity funds or active managers chasing earnings season. Wall Street banks are already tightening. Former Treasury Secretary Paulson is openly calling for an emergency plan to protect the $31 trillion Treasury market, warning this crisis differs from 2008. Gulf leaders fear a global food crisis if the strait stays shut much longer, yet markets price in quick diplomatic wins that may never arrive. So who blinks first? The economically suffocating Iranian regime losing $350 million daily, or the optimistic bulls betting on a rapid breakthrough? External Chinese life support might let Tehran endure months longer than expected, forcing Trump to either escalate dramatically or accept a messy, prolonged stalemate. Their outcome sends inflation higher, delays central bank easing, and squeezes manufacturers already facing cost spikes without adding headcount. The labor market holds firm for now, but Citi warns unemployment could climb toward 4.5% by early June if claims finally break higher. Stock records look smooth on the surface, yet the report's through line warns underlying signals are far more nuanced and dangerous beneath the headlines. The Strait of Hormuz remains the variable that matters most closed tight, while traders pretend diplomacy will magically reopen the world's critical energy artery soon. This standoff exposes the hypocrisy. Trump's pressure campaign is working exactly as designed, forcing Iran to choose between collapse and painful concessions, but the timeline remains brutally uncertain. Investors must now prepare for volatility because optimistic ceasefire hopes clash hard against the report's clear warning of building pressures on both sides of the Atlantic. The coming weeks will decide whether this blockade breaks the regime or merely prolongs a high-stakes poker game with devastating costs for everyone involved. In the end, the markets are betting on fantasy, while the hard data from factories, labor, and energy tell a far more sobering story of prolonged tension. This is beyond the headlines, and the real test for traders, central bankers, and world leaders is only just beginning.